Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Monday, September 18th, 5:45 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market as of the 8:29 O'Neill follow-through day, we've been in an uptrend, but it's a weak uptrend, not making any progress. In fact, we're hanging out now at the NASDAQ 100 and the S&P 500 at the lows of that follow-through day. You can see the trend gauge over here. Last week, late last week, we downgraded leaders from bullish to neutral. Not a lot coming off the 21 over 21, but the RG8 charts not looking their best and not making any progress really on market leaderships. Then we take a look at the 5 major indexes against their short-term 21-day moving average, medium-term 50-day moving average, long-term 200-day moving average. Bit of a mixed bag here. We've got mid and small caps firmly below their short-term 21-day and medium-term 50-day moving average. Dow, NASDAQ, S&P broke below there late last week, but they're at the bottom of the range, and the slopes of these lines are about flat. Flat moving averages really act more like a net than any sort of support or resistance area. But what we're looking for is some sharp follow through either to the upside or the downside to establish some sort of a trend, which we don't have right now. Long term, added small caps with the yellow arrow as they closed again below the 200-day moving average today. Definitely the weakest segment of the market. That's hurting certainly the breadth numbers and the high-low numbers, and you can pretty much point the finger at the small financials for that. So what happened today? It's day 14 of the S&P 500 NASDAQ 100 consolidation. Since the follow-through day, we're near the bottom of the range there, and small caps breaking the 200-day, as I mentioned. Really not a good scenario there, but we are, if you're a glass half full guy, and I am, we're holding the lows of the consolidation. The Fed, the FOMC meeting Wednesday, they'll announce there's a 99% chance of no rate increase, and they won't want to surprise the market, so expect nothing happening there. Then it really comes to the economic data that comes out and what they do for the rest of the year. The market puts about a 30% chance on another increase by the end of the year. Here are numbers on the day. Our 8 growth ETF composite down 0.5%, S&P 500 up almost about 0.1%. Same thing with the NASDAQ 100, Dow barely positive. Mid caps down 1/10, Russell 2000 small caps down 0.7, global diversified 60/40 stock and bond down 0.08%, in-house GROTECTION down 0.16%, dragged down by two of our leading positions, Uber and Tesla. Uber down 2% today, Tesla down 3%. Tesla stands to benefit from this big strike that's hitting for GM and Stellantis, but it hasn't shown it yet. Let's get into the charts. Start off with the S&P 500. Let's take a look at the stochastic here. First of all, they're all pointing lower, so that's bearish. We'll take it off to make the charts look a little bit bigger. So here's the S&P 500, and you can see the above and below action versus the stacked moving averages over the last 2 weeks. Let's go to the 30-minute chart. So I can clear. Here's the August 29th follow through day, and I've been kind of drawing this for a while. We had a false breakout out of this triangle last Thursday, gave it all back Friday, tight inside day today. Not inside, we barely broke below Friday's lows, but inside this range, let's say. But out the bottom of the range, 44.30, kind of consider that kind of a line in the sand. We break below there. The next level down is 43.56. That's quite a drop. Let's go to a 60-minute chart. 44.35 was the correction low as of right now. So the test, we didn't undercut there, but definitely 44.30. Since it's the follow through day, 5th day off the bottom, it was That's the line in the sand that we're looking at. Let's keep this chart up here and go right to the NASDAQ 100. Here's the low, the follow through day. So not quite getting down that far, more like 368, 369-ish, 380 on the high side. We broke out of that triangle again. Same situation on Thursday. It failed Friday with the move down toward the bottom of the range, which held again today. Today's low is kind of critical. They line up with the lows from the 7th. And then just below that are the lows from the 29th, which was the follow through day. So those are the key levels that we're watching until the market makes a decision one way or another there. Not just making any progress. Leaders, definitely some bifurcation in sectors. We took a look at those last week. Let's go to the Dow Jones Industrial Average. Better setup here if you look at let's go to the 30-minute for comparison's sake. So you can see we're very clearly making higher lows on the Dow. That's typical that the Dow shows relative strength when the NASDAQ is struggling. Here's the follow through day on the Dow. And for a while we were showing relative weakness as we undercut the lows of the follow through day. Same situation with the triangle. If we avoid, take out the spike lows, a false breakout there, but looking better on a relative standpoint. And you can see that over the last 2 weeks with the relative strength line poking higher and poking its nose above the 21-day average of the relative strength line today, but still below the 50 and the 21-day moving average. Now, here's where we start to deteriorate. Here's mid caps firmly below the 50, ran into the 21 last Thursday and failed, and near the bottom of the range. And that bottom of the range also coincides with the 200-day moving average. Here was the follow through day. We've clearly broken below that, and the lows of a couple of days before the follow through day are where we're plumbing on IW or on mid caps. Same situation with small caps, though we haven't quite broken below that lows of the day. Here's the follow through day. Clear relative weakness there. So we're below the bottom of the range, but the range goes lower. And again, a close. We barely closed below the 200-day moving average last Wednesday, close enough for a rounding error, but a little bit more of a close below it today. Massive relative weakness on small caps. And again, that's hitting the breadth numbers. Let's go to the VIX. It's had a spike today, ran into the declining 50-day moving average back below it and the 21, holding below that 15 level. Volatility is contracting. The range today was just barely over 0.5%, and this is typically good news. But we've got this 2-week seasonal weakness period. You almost, from a contrarian standpoint, want to say that we might rally over the next 2 weeks because everybody's expecting a further pullback in the market into the end of September, which historically are the 2 weakest weeks of the year. You've also got the old Wall Street saying sell Rosh Hashanah, buy Yom Kippur. Rosh Hashanah was over the weekend. If I'm mispronouncing that, forgive me. But so a lot of perceived wins, headwinds for the market, and the market's fighting them, but not making any progress, but hasn't broken the lows on the S&P and the NASDAQ. So certainly the bulls hope that continued. Okay, we show the VIX. Here's the dollar. Another problem. Last two sessions inside Thursday's big pop for the dollar, which coincided with the market shook it off immediately. Dollar up and market up has been a break of the inverse correlation, but gave it back Friday, where the dollar kind of holding up. Down day today on the dollar. How did that impact precious metals? These are looking better over the last week and a half, getting back above the 50-day moving average, back above the 21-day moving average. They've been in quite a long downtrend. Downtrends don't go on forever. At some point, you get at least a counter trend rally, which we did here. sometimes that counter trend rally can really be strong and turn into an uptrend. That's what we tried to do back here in March, but it failed miserably with the rollover as it rolled over. But we're forming a little bit better of a bottom here. And if you go to the 30-minute chart, you can see we're at the top of the range. Here's the follow through day for gold miners. You certainly don't count on gold miners being a leading uh, sector when you're having a follow through day, especially considering that they really broke below the lows of the follow through day within 5 days after that and stayed below it for an additional week before showing some strength, particularly over the last 3 days. So we'll play this with NUGT if we get a continued move in the gold miners, but two closes above the 50-day moving average, and holding that gap from Friday. GDX, okay, was up slightly today, but at the top of the range. GLD up 0.6%. Again, big relative strength over the last 2 days, back above the 50-day moving average. Silver SLV, after this miserable breakout failure, looks like it put in a bottom with the positive reversal on Thursday, held up fine on Friday with the gap up and coming into the declining 21-day moving average. That's high host silver. On to bonds. Well, no, Bitcoin, we got to do that first. Bitcoin negative reversal, but a close above the 21-day moving average, also showing relative strength over the last week. Now on to bonds. They traded in a tight range today, but closed at the top of the range, up 0.11%. That's the broad bond index TLT. Undercut, but closed at the top of the range, up 0.6%. So if prices are up, yields are going to be down slightly. Here's the 30-year TYX, down 0.34%. Didn't pass the highs from 3 weeks ago. TNX, the 10-year, didn't quite surpass the highs, challenged them today, and then had the negative reversal. So that's all the inter-asset correlation we go through in every one of these videos. Let's go to the tail of the tape. You can pause this. Nothing really good on the stochastic standpoint from the major indexes, the RG8, the NASI, RSI, the dollar, or yields. But again, things can only get so bad. And then you look for everybody leaning to one side of the boat to go back to the other, but you don't anticipate it. You wait for some sort of a signal. VIX at 14 is where it closed. That's up 1.5%. We're leaning toward the bear case now if we can't get back above the moving averages. 14th day of the consolidation, virtually no chance of a rate increase on Wednesday, as I mentioned. Sectors today, semiconductors, finally, they've been lagging. ITB also lagging, so maybe a dead cat bounce there. Oils started out strong, reversed, a little bit of strength into the close. Banks and XLY, which is Tesla and Amazon, are the big part of that. And with Tesla being down 3.3%, XLY really doesn't have a chance. Here are some charts we're going to look at here on the focus list, but I want to point out we did institute the change in our Revere volatility adjusted beta based on running hundreds of thousands of statistical analysis on sample portfolios, working with our data scientist intern Luke, and the result is it decreased changed the calculation that decreased the risk perception by 0.93%, but a little more than 10%. So today's day one of, we'll call it RVAB 2, and 0.93. The S&P, the baseline is still 1.0. That's the S&P 500, both on a ATR basis, and it's always 1.0 on the beta baseline. As I said, 1% a day on the S&P ATR, and that's declining. That's one of the checks in the positive column. But bottom line on the day, S&P and the NASDAQ tight range near the bottom of this 14-day consolidation. Small caps broke below the 200-day moving average, and we've got the FOMC on Wednesday. Let's look at a couple of charts. Let's start off with SOX, which outperformed today, but it's been an underperformer. It's near the bottom of that range as well. Here's 829. Here's our follow through day on semiconductors, and you can see we're below the low of that range. If you go to the 30-minute chart, very clear that we're below it there, that we broke below it, tested it on the 11th, traded in a tight range, broke down from that range badly on Friday. Back to the daily charts and back to NVIDIA, as NVIDIA had a big gap down today, but I want to point out a couple of things here. Last time NVIDIA had attempted sell-offs, there's 3 of them going back to 815, 814, and buyers come in during these perceived, they're looking for value here. So it's holding up. It's below the 50 and the 21. It's holding up. Let's look at it relative to the follow through day. That's here. So looks a lot like the chart of the semiconductors, which it should. It's a big holding in them. And you can see the breakdown there Thursday, and then the big gap down in the morning that was immediately bought up. So don't carve the tombstone for NVIDIA just yet. If you look at the 60-minute chart on those gap down days, it gets bought. I don't know how many of these are actually showing here. Does it go back far enough? That's 814. Yeah, here's 814. Here's the gap down, and a gap down and an undercut below. So look again, the sell off, gap down, bought up, sell off, gap down, bought up. Not saying it's putting in a bottom, but it's putting up a fight. Let's say that. Some things that acted well today: APP making a higher high, nice volume, up 3% on the day. On the 21 over 21, relative strength confirming it, nice volume over the last, well, Friday's volume goes with an asterisk because it was that triple witching options expiration. But this showing relative strength since its gap up, actually two earnings gaps. Got to have that on your list, and if the market was right, this would be acting quite a bit better. On the other hand, something that has been holding up but gave it up a little bit today is Nutanix breaking or testing the low of its earnings gap up day, so showing relative weakness certainly over the last week. Array showing some strength. Definitely, we've talked a little bit about how this is like the only solar stock. You can see the group relative strength rating here of an E, the only one that's acting well. But negative reversal on Friday and down another 4% today. We want to keep an eye on that because any strength coming into the solars, this one should fly. IonQ, another one, big negative reversal middle of last week, broke the 21, gapped up today, had a big negative reversal down 5%, sitting on the 50-day moving average. This is the quantum computer company. They haven't delivered anything, but they've got a ton of orders for them. Fastly, we owned this last week, and it went from the penthouse to the outhouse, breaking below the 21, another move below the 21, all the way down to the 50-day moving average today. Just a lot of selling in Fastly. You just can't trust breakouts in a market when it's pulling back and it doesn't have the wind at its back. Another leader, NVO, gapped below the 21-day today. Some reports of quality control issues at a plant in the U.S. You never want to hear that, especially if it's a drug maker, but this is really just consolidating sideways since its earnings gap up on a relative basis. About $20 off of its highs from the middle of last week. Lilly is holding up better. In fact, Lilly looked like a good entry today off the 21-day moving average. If the market was better, we'd have considered it. In fact, we are considering it as it's pretty low risk and also showing relative strength. Let's go through the portfolio very quickly. Here's Tesla. You could see the gap down and breaking below the 80 MA. Volume was below average though. VRT gap down below the 21, closed near the top of the range, regaining the 21 by the end of the day. Also seeing it up a little bit on some volume after hours. Not sure if there was news on it or not. Uber, our largest position, sitting basically right on the 21, no strength, relative weakness over the last week. TBT, this is our interest rate play, negative reversal after going toward new highs. NRGU continues to act well. That's the way we play energy as long as it holds the ADMA. We've taken profits into strength last week, riding the ADMA higher. And then we've got the big SSO, that's the anchor of the portfolio. We will not be rid of that unless it breaks the 200-day moving average. Won't be rid of it completely. We've got the system has us reducing if we break below the 100-day moving average and the 150-day moving average. But remember, the market never gets into serious weakness unless the S&P 500 breaks below the 200-day moving average. That's where all bear markets occur. And the 200-day moving average now is back above the June, or right at the June breakout level at 4,200. So that's it should be major support if we get down to this 4,200 level. That's 250 points below where we are, 6.4% below where we are right now. And that's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. If you're interested in becoming a client, my partner, Dan Stewart, dan@revereasset.com. Phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the markets, it's how much of that you can keep. We've been towing the line over the last couple of weeks between trying to make and trying to keep, as the market has been doing a bunch of chopping around in a range. Seasonally weak part of the market. FOMC on Wednesday will possibly provide some direction. Until then, we're playing it light. So with that, I'll wrap up the video for Monday, September 18th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great day.